What's up, everybody? Welcome to Let's Talk Markets with Dave Lauer. I am your co-host, Pink. And as promised, we're doing another episode of our monthly check-in on talking markets with Dennis Dick. Unfortunately, Eric could not be with us today, and we're still not sure whose fault that is.
I think it's our fault. I'm going to blame us.
Yeah, we'll take the blame so that we don't want Eric to seem like he didn't show up for us. I think he might not even know that we're doing it. So, but we're going to go ahead and continue because in spite of the fact that we have a continuing Canadian contingency here, I'm outnumbered with by Canadians, and you guys are getting snow, and I'm just now barely getting to like reasonable temperatures. So how's that going for you guys?
Yeah. It's cold.
Yeah.
I mean, and it's cool because Dave's new to Canada, so he doesn't realize that this is actually kind of nice for November. It's going to get worse. It's going to get much worse, and the snow is going to continue, and you'll get the shovels out very soon. Flurries, I don't mind. 2 feet of snow, I mind.
Yeah, flurries, wow. That's what we're getting. We're getting flurries before Halloween. So officially snow before Halloween, so that's cool. We're going to try and get the kids to shovel a bit this year. We'll see how that goes. I don't know, Dennis. What do you think?
How old are the kids now, Dave?
8 and 11.
Oh yeah, they're shoveling. They're doing the whole job.
Yeah,
get them out there.
The whole job, right?
Yeah, I think 9 and 6. The 9-year-old's going to be out there. He doesn't know it yet, but he's got his own shovel, and he's going to be shoveling this year.
Everybody's got to kick in, huh?
He'll want to drive probably the tractor there, so he'll probably want to push the snow.
See, there you go. That's pretty cool. Yeah, we just have the manual shovels, and I don't know. Yeah, my 8-year-old.
You'll upgrade to a tractor eventually.
Actually, no. So here's a funny story. My wife, she was like, "No, I don't want to get a snowblower. I like the workout. I like the exercise." Because she shovels. She did most of our shoveling going into last winter, and of course, like a month into last winter, she hurts her back. So who's shoveling the whole rest of the winter? This guy. And then, so my neighbor and I, we've schemed that we're going to split the snowblower and just not tell her about it. And then be like, oh, look, I'm just borrowing the neighbor's snowblower, which I can talk about because my wife doesn't even listen to the podcast. So she has no idea that it's happening.
That's how to keep your marriage great.
Snowblower is not a bad idea.
Yeah.
You got to get a heavy duty one here. You can't get like one of those dinky electric ones, right?
No. And I lived in Windsor a lot of my life, and I had a small one down there in a little subdivision, and I brought that up to, I'm in Georgian Bay here now, it's called the Snowbell, and everybody made fun of my snowblower, especially, my father-in-law and everybody up here is like, what are you going to do with that thing? I'm like, I'm going to blow my driveway. No, you're not. And they were right.
Yeah.
Did they call you a hoser?
Talk about tractors. We have a different use for that. We woke up the last 2 mornings with new baby goats. So
nice.
When it gets cold around here, we get new baby goats. They like being,
where are you? I forget.
I'm in the middle of Oklahoma. I'm actually in the Cherokee Nation. I'm a Cherokee native. So I live within the land, and we have a little farm here, and we have fun.
You've got puppies too, right? So you've got puppies and baby goats.
I've got a little bit older corgi puppies.
Oh my god!
And we have 5 acres that they just run around, and everybody has a great little life out here in the country. So, tractors are definitely not used for snow around here. We have nothing for snow. We're not prepared.
If snow shows up, you just don't work that day.
It all shuts down, right?
Well, thankfully we do. We do it all online. But yeah, you don't go to school. Even a whisper like what you guys are saying now, school would probably be canceled. So.
Oh yeah, flurries, school canceled.
Yeah.
And we get 6 inches of snow, and we call that Tuesday. Not a snowstorm. That's just Tuesday. So the kids go to school, Matt.
My kids have not. I don't think they've missed a day of school for snow in 2 years since we've been here, despite like tons of it.
Yeah.
My wife
what we would consider a blizzard
coming out in order to miss, for the schools to shut down.
Yeah.
Wow. Well, that's a different.
It's basically got to be whiteouts where you can't see.
Then
they don't go. Snow you can see, but if you got a whiteout, and we do get whiteouts up here where they actually physically close the roads, like you can't even travel these days because it's what it is, the snow buildup and then blowing across the highways. Then it's a whiteout. Then they actually close the roads, like cops there blocking the roads. No, you stay where you are. You can't go on the highway today. That happens a couple times a year.
So
Yeah,
redneck question. Do you guys lose internet? Like at what point, when do you lose internet or if like
Not that often, actually. Mine's pretty good. And it's Rogers, to be honest. Are you Rogers? What are you, Dave?
Bell. I'm Bell,
You're
baby.
Bell.
I got Bell fiber. It's all good.
The only time we lose is when the Rogers had that major outage for 48 hours. And
Oh,
I
that
wanted
was
to kill
terrible,
Rogers.
yeah.
That was terrible, man.
Yeah, unless you lose power here, you don't tend to lose internet. And we're once again, I think this is all me. We're in this like enclave that since I've been here, we haven't lost power despite like tons of people losing power around us. And the reason I say that's all me is because when I was in Jersey and Hurricane Sandy hit,
oh gosh,
I was in like this tiny little pocket. It was like half of our little town didn't lose power, and the entire rest of the state lost power. And we were like, "Oh, that sucks for you guys. We're all right."
oh the neighbors
we had
did
internet,
not
we had
like
power,
you?
so that just doesn't happen here. Yeah,
Wow.
yeah.
Lucky.
I've got the Generac, so it does help. So
there you go. we need
Yep.
to get. We've been meaning to get one of those.
yeah. And GNRC's having a day too, up 13%. So
All right, see, there you go. Topical.
There you go. We'll segue
market.
into stocks here. Pink, we'll bring
Tis
it
the
back.
season, I guess, right?
Yeah.
Tis the season for cold stocks to go up. So as promised,
Maybe.
we are continuing the monthly discussion on Let's Talk Markets. And last month, Dennis, you were talking about the canary in the coal mine that you usually reference being Treasury bonds. How are those looking?
It hasn't really gotten better, but it hasn't got that much worse. So when we were talking last month, I think the TLT was around 88, 87. We've come down a little bit, but we've actually stabilized. So we have gone lower and the markets have gone lower. I've been saying IWM and TLT are linked at the hips. I mean, Qs can sometimes do their own things. They're not as rate sensitive. The stocks, some of the mega cap tech doesn't have a lot of debt, not as rate sensitive, but stocks with small caps, very dependent on capital. So when capital conditions get tighter, and that happens when long-term rates start to go up and short-term rates, obviously, you start to see stocks weaken. So TLT, IWM are linked. TLT has stabilized, though, and that's the good news, is that we are seeing over the course of the last 2 weeks, not new lows. I've been calling it the Ackman bottom because if you go back and if you want to show a chart, I don't know if you have them on there.
I've got here. But I just put up SPY, XLU, and TLT, which is what we were talking about last month. And this is just looking at them since that episode that we recorded.
Yeah, and on, I believe, and don't quote me on the date, but I believe it was around October 23rd, Ackman tweeted out that he had covered his bond shorts. And that day, bonds rallied significantly and the TLT rallied significantly. Right there, we have not breached that low, and I'm calling it the Ackman bottom for the last 7 trading sessions. So that low is still intact. And now we're trying to fight up against 85 resistance on the TLT. So if we can start to form a little bit of a rally in the bonds, meaning long-term yields obviously going lower, that's going to be good for a lot of stocks and a lot of stocks that are really beat up, and those in the IWM, because we really have had the tale of two markets where we've got small caps and the IWM, which is 33% off the all-time high, and then you have the S&P, which has been very resilient because of the Magnificent Seven. And the S&P, I'm not even sure if we're in correction territory. Yeah, we are barely in correction territory. Actually, I don't know, 460 down to 422. An official correction is supposed to be 10%. So we're just shy of correction territory now. Earlier in the day, we may have been in correction territory, but we've rallied up here. So you can see tail of two markets, IWM broad market, a lot of small caps down 33% from the highs. S&P holding up very well because of those weightings with the Magnificent Seven.
Yeah, it's funny. I saw a chart and it was looking at different indices, and like exactly as you're saying, Dennis, it's just there's a dramatic difference depending on what you're looking at, right? So like the Dow is almost even on the year, up 1%. S&P 500 up almost 10% now. NASDAQ 100 up 32%. Russell 2000 down 5%.
Yes.
It's crazy, right?
If you haven't been in the Qs, and again, that S&P outperformance is because of those 7 stocks as well. Take those 7 stocks out, you can actually look, probably a better gauge is the RSP, which is the equal weight S&P 500. And I believe if I'm looking here, that is indeed down on the year. So, I mean, you have really 7 stocks. People will keep saying, well, it's more than 7 stocks. There's 100 stocks up in the year. Yeah, well, there's 300 that are down. If you take out those 7, and we keep talking about those, obviously, NVIDIA, Amazon, Apple, Google, Microsoft, Tesla, and whoever I just forgot, take out those 7, and obviously this market looks a hell of a lot different. Now,
Yeah,
but the
RSP
question
to
is
start the
going
year
forward.
was at 154, 153. Now it's at 136. So yeah, RSP down on the year.
That
Quite a
are
bit.
down on the year, and
Yeah.
that's the equal weight S&P 500 giving equal weight to those same exact 500 S&P components, because obviously the Microsofts and the Apples skew it all higher because they've had a really good year. But I mean, we're in this market where actually stocks in the last few days, it's starting to feel a little bit better, where you're starting to see dips get bought. TLT has stabilized, meaning the bond market isn't just in shambles like it has been. It's starting to stabilize as well. So I think there's hope, and I think seasonality sets up well here too. So if we did this a week ago, I was probably a little more nervous than I am now, but I'm feeling a little bit better about stocks in the last few days, just because we are seeing some buy the dip mentality come in here. AMD, for instance, did not have a great quarter, yet the stock, the dip was quickly bought up last night. Stock opened near the lows and has rallied all day. So you're starting to see the tech stocks are really the stocks that they gravitate to, and they continue to do that. They continue to outperform. But this is not one of the Magnificent Seven. It's a stock that has been in decline here. So it's nice to see a stock like this really turn the market around today. It really turned the chips around, and it really caused a lot of the tech stocks to start catching a bid. So AMD was the leader here today.
That's funny because their results were so much worse than Intel, right?
They weren't great. No, they weren't great. And Intel's response was pretty good too. I mean, Intel bounced off a critical support level of 32, and now we're coming back up to test resistance here as well. But again, it's a tale of two markets. Tech stocks have been fine. They haven't been hit too hard. The Qs are up. It's those small cap stocks, and obviously the stocks, and what I've been talking about, stocks with a lot of debt. If you really look at what has been hammered, it's companies that are carrying a lot of debt, because as long-term rates go higher, eventually all of those companies need to refinance that debt, and it's going to be at higher rates. So you get a company like Apple that has very little debt relative to its market cap that can swallow that very easily. Where if you go at, look at different companies that have really been hit, and we've been talking about, some of the solar stocks, they're heavily debt. And not only that they have a lot of debt on their own balance sheets, it's that their customers require financing to buy their products. So it's their customer base that actually may not get the financing they need to buy their products. And that's why you've seen stocks in the ETF TAN really get hit hard. ENPH has been a disaster. SEDG has been a disaster. First Solar is trying today, but it's starting to give a little bit of it back too. But again, so it's not even a fact that some of these companies have debt themselves. If their customers need financing to buy their products, that financing is coming at a lot higher rate, and a lot of customers are being pushed out of those markets.
And that goes with what you were saying. You mentioned last month how equities traders were kind of spooked at the market. And
yes,
that sounds like maybe we're starting to see a shift going into like the holiday season. Maybe things are starting to ease up a little bit. People are starting to buy in a little bit, like you said, buying the dip. So do you still feel like equities traders are as spooked as they were at this time last month? Sounds like maybe not.
I think we've sold off significantly in a lot of stocks. And again, that tale of two markets where you won't see the significant sell-off in the Magnificent Seven. You don't really see it in the Qs, but you definitely see it in the IWM. But you see it in individual stocks. You can go into like even a Caterpillar, which had a pretty decent numbers here, and it is trying to bounce. But I mean, the stock is sold off from 280 to 220 in a matter of about 4 weeks. So, this is a cyclical stock that a lot of people follow. And again, it's like big machinery though. So people are like repricing and saying, well, if interest rates are going to stay higher for longer, there's probably going to be less people buying Caterpillar equipment, because that financing is just going to be at a higher rate, and might push some people to say, look, I don't need that new piece of machinery this year. I'm going to push that purchase on to maybe next year when financing is more attractive. People may be saying that the rates may go lower. So I think in the short term here, I think there is still a push away from these types of stocks. And again, lots of other cyclical stocks with the same story.
Woo, that's nasty.
It doesn't look like a bull market anymore, Dave, that one. So, and there's a lot of stocks that look similar. I mean, Deere is linked obviously with it. Similar story. The stock has come off, showing a little bit of life the last couple of days as rates. You can see these two stocks linked with rates. Rates stabilizing, going down slightly over the course of the last few days, giving a little bit of life to Deere and Caterpillar.
But definitely, if I know that the Fed is they've talked about raising interest rates, but there's also buzz that maybe it might be in a downward trend, I'm gonna wait as a consumer who needs a tractor, quite frankly, like we were talking about earlier. Yeah. I'm not going to go finance one right now at these rates. If I can wait 6 months and in the spring, maybe it'll be a different situation. So that definitely makes a lot of sense.
probably worth mentioning because it's 3:30 on Wednesday, November 1st right now. The Fed announcement just came out an hour ago. They kept rates steady. It was hardly different. The statement was hardly different from the previous month, other than they noticed, I think they mentioned some fiscal stress along with the credit stress that they had noted the month before. And I saw that Fed swap show the market is expecting a 50 basis point cut by September. So it does seem like the market is starting to shift away from fear of hikes to expectations of cuts coming next year.
I think the Fed is done. And listening to Powell, and I was listening to Powell for the hour before this podcast here, just listening to Q&A, and you're trying to read his body language. And, obviously the Fed's still trying to act tough, and we're going to take action, and they're data dependent and all that stuff. But right now, with the data they've got coming in and the long-term rates, going up, and obviously, in the last month or so, and seeing, a pullback, obviously they say they're not market dependent, but they watch it. I think that the Fed in the short term is done here, unless we get a huge spike in interest and obviously inflation in the CPI, that we weren't looking for. I think the Fed is done. So we're at the points where even if they're not done, it's another quarter point. We're at the top of the hiking cycle, which is good news.
13%.
I know, and we had obviously a CNBC talking about rates potentially, and looking at charts and looking up. If rates go to 13%, Pink, you can forget about S&P 4,200. You're going to be at S&P 2,500. We cannot handle rates that are 13%. And people will say, well, we handled them 20 years ago, but we didn't have the kind of debt that we do now. We can't handle these kind of rates. I mean, right now, and I'm in Canada, obviously, and what RBC has been talking about, reading an RBC note here today, is that a lot of Canadians are on fixed mortgages, but for 5-year fixed. Canada doesn't give out 30-year fixed. Typically, they give out 5-year fixed. Yeah. So in the next 2 years, in the next 2 years, is $500 billion worth of mortgages maturing there, and they're going to be up at the next rate. I have a rental property that I've got right now. 1.64% is my fixed rate on my rental property. That will come up in December 2024, and it's going to renew at probably 7+. So I mean, there's lots of people that are in different situations, but I mean, there will be some situations where people are going to not be able to have the luxury of having a lot of extra cash when their rates renew. It's going to be a shock, and a lot of people are saying, well, rates are going to come down in 2024, and I'll be okay, and they're waiting it out. So they're still spending as if they'll be okay as rates come down. But if rates do not come down as quickly as they went up in 2024, there could be less spending going forward. And I mean, in the US, a lot of people are on 30-year fixed, so it doesn't hit as quickly. But still, financing, you think about the 0% financing with your cars all those years. Now financing rates on your cars is 8 to 10%. So it's just much, much different, and that obviously is going to impact automobile makers, parts makers, all the different companies there. So rates higher for longer.
There's no way rates are coming down in the same way.
Exactly. We're not going to go down unless the economy actually does fall off a cliff. And I mean, not just a reset and hard landing, we're seeing, just collapse in the economy.
Crisis, right? That's when you saw crisis in response to crises, right? But whether it was the financial crisis or COVID.
Yes.
Which a lot of people are talking about within real estate. A lot of people are saying that within real estate, within the U.S. market, that we're approaching crisis. I guess it's more of an attitude of we have to be, right? I mean, where else does this head? And I mean, I remember balking at I think it was 3.4% mortgage when I bought my first house several years back, pre-COVID. And now I'm just like, wow, if we could refi it, that'd be great,
Yeah.
But it's just
3.4% sounds like a dream right now.
Honestly,
I don't think anybody anticipated.
I was embarrassed to tell my parents that it was 3.4%.
And even in the U.S., as you're talking about, Dennis, with 30-year mortgages, where it'll take maybe a little longer than in Canada to really filter through the system. There's another major borrower in the system, and that's the U.S. government.
Yeah.
Right. And right now, Treasury borrowed $1 trillion last quarter, and they're expecting another $776 billion this quarter, over $800 billion next, Q1 of 24. Yeah. They're borrowing at totally different rates than what they were borrowing at before. And now you're talking about interest payments, government interest payments, climbing to be a really, material portion of GDP and the fiscal budget, and starting to crowd out private investment. I mean, that's another serious issue that the Fed obviously knows about and that the government's going to have to contend with.
I mean, that's all. That's a major concern, when you start looking at the budgets, and the fiscal policy going forward. And we've had a lot of fiscal stimulus that has really kept this economy going. If a lot of that money obviously is going to go towards interest payments, that means there's going to be less fiscal stimulus and less money coming from the government to keep the economy just strong. So, I mean, those are fantastic points here, and more reasons to think that, hey, maybe the worst is not behind us. So even though we say in the short term, maybe stocks are oversold, it's hard. And really, like if you just back up and you look, what really drove the bull market of like 2011 to like 2021, 10-year raging bull market? It was low rates. It was quantitative easing. It was free money. That's what drove it. And we're no longer in that Goldilocks scenario anymore, where we have free money. Money costs, negative interest rates. I mean, we're talking about negative. It was absurd to think about, that, negative interest rates. I'm going to loan you money and you're going to give me less back in a year. It was an absurd concept, but that's where we got to. That's where we were going. And it's a completely different environment anymore. So there has been a lot of borrowing, and probably companies borrowing above their means, where maybe some of that's going to get brought in. So it's kind of, and people just think we're going to automatically go back to all-time highs next year because the bear market's been going on here for, over a year, or in some cases an IWM 2 years. And, the longest bear markets typically only last 24 to 30 months. And eventually we'll be back at all-time highs. But we're in an entirely different environment here right now. So even if rates go down, I don't think they're going back to zero. So you've got to reprice assets and capital under those conditions. So that's why I'm in the camp that, hey, maybe stocks have sold off a bit, but maybe we just don't go back to all-time highs next year. Maybe we go sideways for a bit. Maybe we just digest. Maybe companies have to grow a bit to grow into some of these valuations, because when you're paying 28 times for a company like Apple into earnings, it's, when it's 0% interest rates, that 28 times maybe seems reasonable. But when it's 5-6%, that 28 times seems like a lot of money to spend. So like to invest. So I think you've got to look at valuations and a repricing of assets for higher rates for longer.
So do you think that the market is pricing in an economic slowdown in the near future already, or do you think that would be something of a surprise now that maybe soft landing is the consensus?
I think on the IWM, it's priced in a light recession, like where, okay, we're fine with maybe just a pullback. And Generac might be one of the best examples here. I mean, here's a stock that was $500.
Bring it back full circle.
Yeah, 2021, $500 a share. Everybody, looking, on this, everybody's gonna have a generator and a COVID and lockdowns and all that. Well, we're back down here to $95. And you look at, obviously we talked about financing, we talked about, different things, that has driven that growth, but the stock has come back down to price in something serious. So if you look at the recent quarter last night, they guided sales to be down 10 to 12% next year. Well, that sounds really bad. That sounds like really bad news, but its stock is up 13%. Because you know what? Yeah. Well, the market is expecting. Your stocks don't go from 500 to 400 to 300 to 200 to 100 and have, exponential growth going on at the same time. Some of that has been priced in. So I would say on some of these smaller cap stocks, and Generac is probably a smaller market cap stock, not a small cap, but smaller market cap, some bad news is priced in. I think recession is priced into that. And that's why you can see actually seller exhaustion and a relief pop in some of these stocks, despite the earnings not being fantastic.
Yeah, and that pop here is on some pretty substantial trading volume also.
It's a bit of a short squeeze. I mean, people expecting, obviously, we know Generac is in a similar situation to the solar companies. These generators are expensive. People finance these. It's not 0% financing anymore, so it's hitting sales. But, a lot of stuff has been priced in because stocks have come back down. And that goes for so many other stocks that have really been hit, fairly hard. I mean, even the automotives. I mean, Ford and GM, trading with PEs of like 5 and 6. They've priced in a lot of bad news. They've priced in probably a coming recession. Does it get worse, though? Is it a really bad recession, or is it a light recession? That's where I think we've priced in a light recession, But are we ready, if the economy really starts to go downhill in 2024, I don't know if that is priced in.
Okay.
All right. Well, in these last few minutes, I want to just ask you a few rapid fire questions.
Sure.
And just kind of pick your brain and let us know what the first thing is that you think of. I just want you to respond.
Okay.
So if we hit a recession, what events are likeliest to tip it off to you?
I think the events have already happened. I think the rise in interest rates is what really is going to cause. And I think it's just a lag effect. And I think that lag effect is starting to be felt. I mean, Canada just had its second consecutive quarter, I believe, of negative GDP. Yep. So Canada is officially in recession here now.
Just a tiny bit.
Just a tiny bit. Just a tiny little recession. But that may be coming for the U.S., but I think those events have already happened. I don't think we can undo, unless they just start lowering rates, which they're not going to do for no reason. They're not going to lower rates. Everybody just thinks we're going to magically lower rates because we raised them. They're not going to lower rates unless they need to, and that's going to be a slowing of the economy. So I think the damage by the Fed has already been done, and I think a light recession in 2024 is imminent.
Well, that answered my next question. So what would be the best strategy for everyday investors trying to weather the uncertainty and that light recession? You kind of gave us a rundown last month of where to put your money. So maybe we can just touch back on that.
Same thing is I'm avoiding companies that have a lot of debt. I'm avoiding companies that have, customers that need financing to buy their products. So I'm not coming into the General Motors and Fords. They've been value traps. Those stocks continue to go down because I just don't see people going and paying $60,000, $70,000 for a new car in 2024. I think it's going to be tighter markets. And then, obviously they've been squeezed on the other side where labor costs are going up. I think those PEs that they have of 5, 6 are going to be climbing rapidly because I think you're going to see the top line go down, and I'm going to see expenses go up, and those margins are going to be squeezed. So I'm staying away from those type of companies, probably staying more to debt-free companies. And you know what has worked? It's probably the same companies that continue to work, is the Magnificent Seven. The reason they're magnificent for the most part is that the majority of those companies have very little debt, especially relative to their market cap. So Apple, Microsoft, Amazon, Meta, Google, a lot, and Tesla. Tesla's debt-free, which is unbelievable. So valuation is a little bit scary on some of those stocks. If we do go into recession, they could pull back for those reasons. But I think I still stay away from companies that have a lot of debt.
That's a really good point. But even companies with zero debt and plenty in the bank can still be driven into the ground, as one of my favorite meme stocks is experiencing. So,
what's that one?
With stock? GameStop, they've got quite a bit on hand. I won't go on a tangent. We try not to go too specific here, but sure. You just never know. But those are really good points that you brought up, was to look for no debt and little to no need for financing. That's a pretty good direction to go.
If rates are going to stay higher for longer, the companies that are going to outperform are the companies that don't need debt. And Apple, and this is a point that we were making on pre-market prep, there's still 0% financing on your iPhones. So they still have that. You go in there, it's a $1,700 iPhone, and they give it to you at 0% financing for 24 months. So it's a small enough price that they can swallow that up. And that continues to drive it. 0% financing on iPhones is attractive. It's a small luxury item. It's not like a $80,000 car. People can afford a $1,700 phone. It's probably why, and Apple's going to report earnings tomorrow night. And maybe if the stock dips any on it, I think there is underneath demand just for those reasons.
So there's still a corner of the world with zero interest rates. It's just Apple.
Yeah, a very special corner.
Well, I think we're about out of time, and that will wrap it up for this week. Thank you for joining us. Dave, any last parting words for everyone besides joining us on the platform that you were showcasing earlier, which looked so good in light mode, I have to mention.
Yeah, we're showing off light mode. We got a lot of new mobile functionality. We've got a bunch of people in the community now. We're starting to get a lot of postings. So, join us on Irvin, and as we usually say, make sure to like and subscribe. If you're not watching this on YouTube, there were some charts to take a look at, so maybe pop over there, and we'll see you next week. Thanks for joining us, Dennis.
Thanks for having me, Dave. Thanks, Pink.
We'll see you next month.
Yeah, we'll see you later. Thank you.
All right.